please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
The first tick is 0.3 higher, 36 points higher.
The current levels of valuations don't leave much room for error or any such risk-based sell-off.
And today the Supreme Court has given the relief. So it's just like, absolutely in the nth hour, the Reserve Bank's circular has been kind of stopped on its track.
11,409 is where we are at. It's been a pretty tepid and flattish kind of day.
The problem for the market is there are many, of course, in terms of crude, rupee, etc. But large stocks are falling. HDFC Bank, Kotak Mahindra Bank, HDFC, ICICI Bank. These are the kind of names that are dragging the market.
Equities tumble for the second consecutive session. The Nifty gives up 11,300. It becomes the worst performing index in Asia today. The Sensex falls over 500 points today.
The rupee continues to slide, hits another record low of 72.74 against the dollar. Bond yields spike further to a 4-year high, tracking weakness in the currency.
FMCG stocks are the top losers in trade today. The index ends 2.5% in the red. The pharmaceutical stocks slide as well. They end about 1.5% in the negative region.
Supreme Court orders a status quo on the RBI's Feb 12 circular, offers a 2-month window for resolution of large stressed assets in the power and shipping and sugar industries until it hears the case in November.
IPO rules for insurance companies are set for a reject. Sources say that the sector's regulator, IRDA, is in talks with SEBI for a review and may seek an increase in the minimum public shareholding period, which is currently at 3 years. It may also seek a reduction in the portion allotted for QIPs. That is a CNBC-TV18 exclusive. Okay, so those are the top 5 stories which kind of define the day. But really, there was only one story from beginning to the end today, which is essentially markets and the rupee. It's been that way now for the last couple of days. Hello and welcome to a fresh new edition of Markets Today Talk Back. This is the show where we tell you what really happened, what affected the trading today, what mattered and what didn't. We'll tell you 5 stories. We'll take questions. I'm Prashant Nair. With me is my colleague Ekta Batra. Hi, Ekta.
Hi, Prashant. Absolutely. Well, in the next half an hour, we are going to be talking markets. We are going to be discussing all of your queries. We have our guests joining in. We have IIFL's Sanjeev Bhasin on the fundamentals, technical expert Mitesh Thakkar. Evening, gentlemen. But before we get to you, Prashant, I wanted your thoughts in terms of what took place today. It was a second half deluge that we saw.
And no real reason, right? I mean, if you think about it, why did the market fall? I'm talking about the stock market for now. Why did it fall the way it did and so easily? I mean, actually, that is the part which stood out for me. That it just, I mean, it was knife through butter, right? I mean, it just, no resistance whatsoever. And I mean, if you think about it and you look at, sometimes you look at the rupee go and it falls fast, and at least there is the RBI, or at least the fear that the RBI will supply the market with dollars. But the way the stock market went, I mean, it was quite something. Broke down and never really looked back. And I think the sell-off began at about 130 or so. At 130, the Nifty was down 30 points. From 130 till by 330, I mean, the Nifty lost 150 odd points or so. So, I mean, just incredible the way it went. So, that basically made the Nifty the worst performer in Asia. You look at the rupee is, by the way, one of the worst performers. I think by close today, we would be the worst performing currency as well in Asia. I mean, across emerging markets, you'd be hard-pressed to find other currencies which have done more poorly. For the first time, at least in this episode, I guess for the first time, you had a situation where, the rupee fall today followed what happened with the stock market, and the stocks started selling off, and the rupee, I mean, I told you that the rupee, the Nifty was down 30 points at 130. The rupee was down 1 paisa at 130. I mean, and look at what happened after that. The stock markets sort of led, and the rupee followed. It always happens that way, and we've seen this in previous episodes. But I guess for this episode, this was the first time it has started to happen. Both the stock markets and the rupee, of course, are keeping an eye on what's happening with oil prices. I mean, the Brent price is at about 78. So it's about $1 higher as compared to where we were yesterday or even day before yesterday. But, well, that made quite a bit of difference, I guess, for the market. All sectoral indices in the red. Market breadth got smashed 3-1 in favor of decline. So, I mean, all in all, complete bloodbath. Ekta, but in terms of stocks, why don't you tell us what stood out, if any?
Yes, absolutely. Well, I think Titan was, surprisingly one of the top losers on the Nifty today. Maybe there is some fear with regards to the burgeoning trade deficit. So that probably weighed on sentiment there. We have ITC, which was lower, down over 2%. Tata Motors, Hero Moto, both those stocks lost out. And in the red were a lot of the banking stocks. So we had Yes Bank, HDFC Bank, Bank of Baroda, all of these stocks, financials, PFC, Max Financial, which saw a good run yesterday. So all of these stocks were in the red today. In terms of the gainers, far and few, you'd have to say. So it was just about a single-digit number of stocks which gained within the Nifty space. Infosys, which managed to buck the trend. Asian Paints, which was higher. And in the broader markets, it was ILNFS Investment Managers, which saw a bit of buying today. So that stock up 4%. Natco, which was higher from the broader markets in terms of the mid-cap pharmaceuticals. And Spark, which followed suit as well. Okay, well, let's find out, in fact, what our guests are making of the markets. Mitesh, tell us, what is your sense in terms of what the technical outlook would be here on strategy as well?
Yeah. So, good evening, Ekta. I think, we were talking about the fact that in case we break 11,400, we should possibly decline to about 11,270 levels. The only thing which I didn't anticipate that it could happen in a day. Around those levels, I think, there's mild support, but the way this market has fallen and the way the indicators are poised, my sense that even if we get a 1-2 day kind of pullback, I think eventually we should see lower levels. And the next area of good support comes in closer to about 11,100 to about 11,050. So there could be another 200-250 points happening on the downside over the next few days with some kind of strong intraday volatility.
Are you expecting that bounce though, or you think it'll sort of flatter to deceive like today, Mitesh? I mean, till 1:30, till the time the market sold off, the opinion was, well, okay, there will be a bounce. 11,400 is not breaking, but it never really came. And then by close, we saw what we did.
So Prashant, it's always difficult to guess. I think, the way you approach it, that you wait around 11,400. If you see there's a reversal happening, 30-40 point kind of bounce back, then you try to take a long position. Similarly, I think again you're back to 11,270, 260 zones. In case we start getting past 11,300, maybe there's some evidence of the support level holding. In case we open gap down and continue below 11,250, then I think there's no need to attempt a long position.
Okay, all right, Mitesh, just hold that thought. We'll get in some opinion now. We spoke with Gautam Chachoria, the MD and Head of India Research at UBS Securities. He says he has not seen any big sell-off in emerging market funds yet, and also adds that risk-reward is not attractive in the market.
The downside for US, European equities could be meaningful. For Asia, equities is generally now getting priced in. And India specifically has outperformed a lot in the context of this outlook, also because of the strong local flows. So fundamental wise, the India long-term story obviously remains intact. So there's no reason to argue that India will necessarily have a bear market over the next 2-3 years. But having said that, the current level of valuations don't leave much room for error or any such risk-based sell-off. We haven't seen any big sell-off or redemptions in emerging market funds yet, despite the pressure points we have seen over the last couple of months.
All right, we move on to the second headline of the day, and that is essentially the currency. The rupee continues its downward journey. It hit another record low of 72.74 against the dollar today. It's basically erased the morning gains which we had seen, and that was about, 15 paise early on in trade. Bond yields spiked further to a 4-year high, tracking weakness in the currency. We've got Rabobank's Hugo Erkin, who is now with us to sort of give us some perspective, tell us what he's making of this. Hugo, thanks very much. Appreciate you joining in. There is. I mean, actually, dollar was on the back foot today against G10 or some of the other emerging market currencies, and so in a way the rupee was picked out for special treatment. So this is, at least today, is not part of this broad EM sell-off. What's going on, Hugo?
Yes, well, it is a bit striking because we all saw the news last week with also the Trump administration putting on the flare within the trade war announcements, and you would expect that markets would anticipate these moves and also price it in. So, from that perspective. It is. We could anticipate a little bit more downward pressure on rupee, but obviously things have come down a little bit, but we still feel that India at the moment is sort of in the perfect storm with a couple of developments that are playing simultaneously at the moment. So we're talking about the oil price, which is still $78 per barrel. Of course, we are anticipating the new moves by the Trump administration, and obviously there's also the country-specific events that are at play here.
Okay. Hugo, how much of a Fed rate hike is factored in at this point?
That's a little bit a tricky one, especially what we find the most peculiar one is the fact that India is bearing the brunt of the global risk-off sentiment due to these country-specific elements. And we're talking about Turkey, we're talking about the elections in Brazil, of course, deteriorating institutional quality in South Africa, but also debt and currency problems in Argentina. The fact, of course, is why is India, but also Indonesia, bearing the brunt of these global risk-off sentiment? Obviously, investors still put India in the same asset class as these vulnerable countries, but we have some doubts that this is justified based on the fundamentals. Because if you look at, for instance, taper tantrum, many of the fundamentals, which are basically at the heart of the INR, are looking much more profound than they were back a couple of years ago. So from this perspective, and also if we look at our models that we run based on these fundamentals, we would expect the INR to be somewhere between 68 and 69. So there's a large gap and deviation between what we actually see on the markets now, which is, in our opinion, still sentiment-driven rather than economic, justified by the economic data. And we still feel that once the dust has settled and investors began to reassess these fundamentals, perhaps the rupee will even gain some strength versus the dollar.
Okay, all right, Hugo, we're going to leave it on that note. Thanks very much for joining in. So that is the view coming in from Rabobank. But Sanjeev, just wanted your thoughts in terms of what took place today. Do you think it was the rupee which really led the decline and fears of, say, a burgeoning trade deficit? Or do you think that there was just profit taking in stocks?
Well, it's, one follows the other, and that most of the FIs, their unhedged positions would now be exposed, and what they were or relatively not making on the stocks, they definitely were losing on the rupee. And I think it's a sort of a panic mode. I would say we are now near capitulation. In 2 days, we've lost almost 350 points, which is telling you, like, proverbially the capitulation of both the rupee bond yields and some of the FI withdrawals, which are not being countered by some of the local flows. So like I said, it's a cascading effect of all three together, and that is what has seen this sell-off get more, sharper as we got closer to 11,300.
Mm-hmm. Okay, we'll move on to the third story of the day, and these are essentially two sectors which lost the most. That is FMCG and pharmaceuticals, which were under pressure. The FMCG stocks were the top sectoral losers. There was some strong selling pressure. FMCG index ended down about 2.5% in the red, led by heavyweights like ITC and HUL. We also had pharma, which could not stand up to essentially what was going on in the rest of the market. Although, pharma and IT benefit with rupee depreciation. The index, that is the pharma index, ended about 1.5% in the red. The fall was led by the likes of Sun, Cadila and Glenmark. We've got a question on ITC, but before we get the question on ITC and get responses, Sanjeev, a quick word on the fall that we saw with regards to, in the FMCG broadly. With 10-12% cuts, many on the street were starting to say maybe these are good levels to start to buy, and then we get another day like today, 2.5% lower. This clearly looked like people taking profits where there are excessive profits.
Correct, and that has been the startler in this fall, that it has been pedigree stocks which have been outperformers in the last 2 years, particularly the consumption basket, and everybody talked about them being very expensively priced and yet were happy when they were making money. Now, of course, that has reversed, and I think they are coming down to more realism, which is very, very good, because I think the excess valuation or the fat in them is getting diluted. It also tells you that the sell-off is more to do with the money being actually taken off and some NAV protection by mutual funds, and that would be healthy for the market. You know, one part of the market was leading and it was getting more and more, the weightage was going up, and that is what is seeing more correction. I would say it's a very healthy correction. Consumption remains the best theme. So if you are looking, then these are opportunities where you should be putting your money where your mouth is.
Okay, well, we have a query now. Hemant Kumar from Bangalore has written to us with a question on ITC, wants to know the right time to invest 5 lakhs in the company. Mitesh, 1, would you recommend it? And 2, what is the right time?
Yeah, I think very much. See, the stock rallied from about 255, 260 to about 320, is correcting that fall. Plus, the medium to longer term charts still remain healthy despite the fact that the short term correction, and in this week itself, you've seen the stock drop by about 5%. I think closer to about 285 is a very strong support. I don't expect it to be taken out. So I think these are good levels to start investing. And you can keep a stop loss below about 270 odd zones. And I think 320, 350 are the 2 targets on the upside which can be looked at.
Okay, we got a caller now with a question. Sanjeev is calling us from Chennai. Sanjeev, hi. Good afternoon. What's your question?
Hi. Yeah, I wanted to know about Marksans Pharma. I've been invested in this company for quite a long time now, almost 5 years, and I have been waiting off late. I think this has been going down, so I just want to know what do I do with this share.
Okay, and you have a large quantity, 8,300 shares. Your cost is about 45 rupees. It closed today at about 36. You want to know whether to hold or sell. Sanjeev, do you track this one? If you do, I mean, what would you tell Sanjeev?
Well, I've not tracked it recently, but this has been some sort of a laggard in the pharma sector, and you know, the last 1 year has been for the whole sector, but it has not started to outperform as has some of the others. So since he has a large holding, I would advise at least 50% to move out of that and get into better names. You know, we like Sun, Dr. Reddy, Lupin, Aurobindo. We think those are going to give stellar returns in 2019. Okay. So hold half of your holding in that, and in the other half, try and get into bigger large cap names.
Mitesh, briefly, Marksans Pharma on the charts?
See, not much. I think, you know, it's been an underperforming stock in the pharma sector as well, and I think maximum upside I would see possibly here is close to about 50 odd levels, and that might also happen with a lot of time. The longer term charts are yet to turn, while for the larger cap names have turned. So I think I would agree with Sanjeev's outlook that better to switch into large cap stocks, which will anyways give more than 40% compared to what Marksans is showing from current levels today.
Okay, we'll take a break now, but stay tuned, more on the other side. Welcome back. You are still with us on Markets Today Talk Back. We have Sanjeev Bhasin and Mitesh Thakkar joining in to decode the day's action and answer your queries. Well, let's get to the 4th headline now. Supreme Court has offered a 2-month window for resolution of large stressed assets in the power, shipping and sugar industries. Hearing a petition filed by these sectors, the court transferred all the cases filed before various courts to itself and ordered a status quo on the RBI's Feb 12 circular. Ashmit Kumar is here with the details.
As you correctly pointed out, what the Apex Court has done is that it has given interim relief to a number of sectors, but primarily the power sector, the shipping as well as the sugar space. The reason for that effectively is that the RBI had moved the Apex Court. The RBI essentially had prayed before the Apex Court that there are a number of petitions that have been filed before various high courts, and therefore, to avoid confusion, it's best that the Apex Court decides this matter by itself. And towards that end, what the Apex Court has done, that it has transferred all these matters, about 12 of them to be specific, to itself, which it will be hearing. But what's important, the biggest takeaway, however, is not the transfer of cases, but rather the interim relief that the Apex Court has given. By way of interim relief, vis-a-vis these companies, the power companies, the shipping as well as the sugar companies that were before the Apex Court. With respect to them, what the Apex Court has done is that it has made the 12th circular of the RBI. The 12th circular was the one where the RBI had directed banks to resolve these cases of NPAs within a period of 180 days. Failure to do so would then compel the banks to take them into the IBC. Now, with that circular having been stated, it serves as interim relief for these parties. But what councils also tell us is that since this circular is applicable across the board to various sectors, other companies are also likely to seek similar relief by way of staying off the IBC process that has been initiated under the February 12th circular. So clearly, big developments coming in for the bar space as well as for the IBC space. But clearly, all eyes are on the Apex Court on how and when it decides on this case. The next hearing, of course, will be in the month of November. Back to you.
Ashmit, thank you very much for that. We still don't have the order copy, and I think that will only come later tomorrow. But this is very significant, and once we have the order copy, we'll have, I guess, a better understanding of the total implication of all of this. But this is big. I mean, by most measure, this is going to impact banks and companies affected and taken to the NCLT or being taken to the NCLT by banks as well. We move on to the last story, and this is CNBC-TV18 exclusive. The insurance regulator, that is IRDA, is in consultation with SEBI. It's all set to revamp IPO rules for insurance companies. Sources in the note tell us that the regulator may reduce the portion reserved for QIBs or qualified buyers from the current 50% right now. Yash has been tracking the story and is now joining in with more details. Yash, what are you picking up?
The insurance regulator has reached out to SEBI suggesting some changes and amendments with respect to IPO regulation for insurance companies. To start with the first one, and this is with respect to diversifying and broad-basing the shareholding reservation pattern for the insurance IPOs. Here, essentially to reduce the QIB portion of IPO from the current point of 50%, and essentially then later on, that reduced portion out of the QIB section should be distributed amongst the various other shareholding categories, be it retail, be it HNI, so on and so forth. The second and most important point is with respect to the minimum public shareholding norms. Of course, we know that all the listed companies are essentially mandated to dilute 25% of equity in public within 3 years of listing. IRDA here has said that it's not likely and it's not ideal for any insurance company to transfer 25% risk in public within that short period of 3 years. Hence, a time extension should be given to the insurance companies as far as that particular dilution of 25% is concerned. If not a time extension, then the quantum of 25% should be reduced. If this particular point materializes in terms of any regulation, and if it is retrospective, then it will benefit a lot of these listed insurance companies, be it ICICI Prudential Life, be it GICRE, be it New India Assurance, as well as SBI Life and HDFC Life, as all these companies have a significant quantum which they are yet to dilute into the market to comply with that 25% public shareholding norm. The third one is with respect to raising debt via Tier 2 bonds. Right now, insurance companies are only allowed to raise up to 25% of their net worth via Tier 2 bonds. IRDA here has suggested to raise this particular limit, possibly take it to 45% of any insurance company's net worth.
Okay, all right, Yash, we're going to leave it on that. Well, thanks very much for joining in and speaking with us. And thanks to our guests for taking us through all of these queries. It's a wrap on this edition of Markets Today Talk Back. Stay tuned, more news coming up.